Most people blame bond market volatility on inflation surprises or central bank decisions. And whilst these factors matter, they are only part of the story. Real bond market volatility is shaped by positioning, hedging flows, liquidity constraints, and the hidden leverage embedded across financial institutions. When these forces collide, yield curves can move violently even when fundamentals haven't changed. One of the largest drivers of volatility is convexity hedging from mortgage-backed securities. As discussed earlier, when rates fall, MBS duration shortens. When rates rise, duration extends. Large MBS holders, including banks, insurers, and mortgage servicers, hedge this duration shift using Treasury futures or interest rate swaps. During rapid rate moves, these hedges can amplify volatility, creating feedback loops where rates move sharply simply because hedgers must adjust exposure. Another major factor is leveraged positioning. Hedge funds often use repo financing to leverage Treasury holdings. When volatility spikes, margin calls force unwinds. This was evident during the 2020 Treasury sell-off, where the leveraged positions had to be liquidated despite falling yields, creating a temporary dysfunction in the world's deepest bond market. Dealer balance sheet constraints also play a huge role. Post-crisis regulation limit how much banks can warehouse. When volatility rises, dealers step back, reducing liquidity, and that means normal-sized trades can move prices significantly, contributing to exaggerated swings. Geopolitical uncertainty, supply shocks, and policy missteps further destabilize markets. Even a modest data surprise can trigger outsized reactions if leveraged funds are positioned aggressively or if liquidity is thin. Volatility also spikes when markets disagree with central banks. If investors believe the policy path is misaligned with fundamentals, even small statements can trigger sharp moves as markets attempt to correct perceived policy errors in advance. Finally, structural shifts such as QT, reducing liquidity, or pension funds rebalancing large portfolios can create large temporary flows that push yields rapidly higher or lower. Bond market volatility is rarely about one thing. It's the interaction of leverage, liquidity, hedging, and macro uncertainty. Understanding these forces explains why rates move violently, even with little new information, and helps investors navigate an environment where volatility is increasingly structural, not cyclical.